You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. Today, I wanted to talk about options for cash flow in your retirement years to ensure your financial stability. Certainly, cash flow is really the most important thing that you'll need in retirement, as opposed to having that comfort of just a large lump sum of assets. Really, what you need is the cash flow that those assets can spin off for you. So if you have sufficient cash flow, then you're good, whether you have a large lump sum that's spinning off that cash flow or whether it's coming off of rental income or something. Really, it's the cash flow that is the most desirable thing to have. There are different ways to help you manage and access funds during retirement, and I wanted to share some of what I believe to be the most effective ways for securing cash flow, including being able to access whole life policy cash values, income annuities, even part-time employment, or other alternatives. The first one I'll go over is whole life insurance policy cash values. Whole life insurance policies serve a dual purpose, certainly, or more than one purpose even, providing a death benefit to your beneficiaries and accumulating cash value over time. One of the ways to access your cash that we talk about a lot, and is what makes the infinite banking concept so awesome when using a whole life insurance policy, is to take out policy loans. We talk about this a lot. A loan against the cash value. This will allow you to borrow money at a low interest rate using your policy as collateral. The advantage of doing this is that the loan does not need to be repaid during your lifetime. You simply have full control of your loan. Although any outstanding balance will be deducted from the death benefits payable to your beneficiaries, and although the loan does not need to be repaid during your working years, of course, it is the best practice to repay your loan with interest. If you have a hardship during your working years and are unable to pay back the loan with interest for a period of time, you do have full flexibility to pay interest only or pay however you would like, reduce your payment, skip a few months or up to a year more of paying. And that's where we talk about how you are in full control of these policy loans, which is what makes them so awesome. However, once you are retired and are borrowing, we would plan to do so in such a way that you wouldn't need to pay that money back. Another option with your life insurance policy is that you can make partial withdrawals from the cash value. This provides immediate cash without the obligation of repayment. However, it's important to note that withdrawals will reduce the policy's death benefit and could have tax implications depending on the amount that you've withdrawn. So you don't want to withdraw more money than you've paid in, because if you withdraw earnings, they will be taxable. Of course, you also always have the option of surrendering the policy, but this is definitely a last resort, especially in your older years. If you have built up cash values and have significant earnings in the policy, then if you surrender it in your later years, you will owe tax on the earnings. Anytime your policy terminates, whether by choice or by accident, you will owe tax on any gains. So if you've been pulling money out from the account for years and it lapses when you're, say, age 85, and you had earnings in the policy, you will have to pay tax on the gain. And that's certainly something you're not going to want to do, a tax bill, a tax man knocking at your door in your older years because, whoops, the policy became taxable because we let it lapse or something like that. We don't want that to happen. So we want to make sure we have a plan in place where there's no risk of you lapsing that policy in your older years. Okay, let's switch gears here a little bit to talk about another way to secure cash flow in retirement, and that would be through income annuities. Income annuities are financial products that are designed to provide a steady stream of income for a specified period of time or for the rest of your life. And they can also pay through your life and a spouse's life. They can be a reliable source of cash flow during retirement for sure. It's something I definitely like to help people with when they've accumulated a lump sum of money, whether in a 401k or some other type of account, and they want some stability, some protection for some of their money, and they want to protect it by maybe putting it into one of these income annuities, because now the funds are guaranteed. They're guaranteed to pay out for the rest of your life and income. It's basically like creating your own personal pension. You would be creating a guaranteed income stream for yourself and your spouse that neither of you can outlive. You can fund this type of annuity prior to retirement or after retirement by simply moving in a lump sum of money into the annuity to let it grow until you are ready to begin income. There are annuities that will guarantee growth so long as you take an income stream in retirement rather than remove the lump sum later on in life. If you're planning to take that money that you move into this annuity, this income annuity, as a retirement income stream in your future years, your retirement years, there are guarantees, as of right now, anyhow. Certainly products can change. There are guarantees in place for some of these annuities. Say, for example, a 7% guarantee for up to 10 years. Just depends on the company and the type of annuity and what kind of guarantees might be out there. But they do have things like this as of right now, and they are great for creating, again, that regular income stream that you cannot outlive. It's guaranteed to outlive you. So there are different types of annuities. This income annuity I'm talking about, there are different types. There are immediate annuities that require a lump sum payment up front in exchange for regular payments, income payments that begin almost immediately. These payments can be structured to last for a fixed number of years or for your lifetime, providing financial stability and peace of mind during your retirement years. So there are three main types of income annuities: variable, fixed, or indexed. Variable annuities offer payments that fluctuate based on the performance of underlying investments. So you actually are selecting investments that your money is in, and then the outcome of your account value is going to be dependent on that, unless, of course, there is a guarantee in place, like I mentioned earlier. Where fixed annuities provide consistent, predictable payments, and index annuities will credit you interest based on how a certain index performs in the market, an index that you select, such as the S&P 500. Now, you're not actually invested in that index, but the interest that you earn would be based on how that index did from one year to the next on your anniversary date. There are certainly other details on how this interest is earned and how it all works. This is just a very, very high level overview of those products. Real estate income. If you own property, renting it out can be an excellent source of passive income, whether it's a vacation home, an apartment, or even a room in your primary residence. Rental income can significantly boost your cash flow. Of course, if you're renting the property, you will have the responsibilities and potential risks associated with being a landlord. Certainly, my dad has some great horror stories of being a landlord. However, if you can get some good renters, this is a great source of passive income. It's become also very popular to partner whole life with real estate, building your whole life cash value and then turning around and borrowing against it to make real estate purchases, whether for rentals or flips. One of the great things about borrowing from your cash value in your life insurance policy or borrowing against your cash value in your life insurance policy to buy real estate is that now you have two cash flowing assets, the whole life and the real estate. Another thing you could do, you could always find some part-time work to help boost your income in your later years. Retirement doesn't necessarily mean the end of work for a lot of people, and a lot of people don't really want to stop working, finding that they may get bored. Many people find part-time employment to be a fulfilling way to stay active, engaged, and socially connected. I'm sure some of you can see how it might get kind of boring just being at home day in and day out, and that this might be a way to stay active and earn a little extra cash. Of course, then there's some of you who would think, I just want to be home day in and day out and just doing whatever I want to do. So maybe that's not for you. In addition to what I've mentioned, a couple of other things you could keep in mind would be that you could maximize your Social Security benefits. Now, I know a lot of you out there don't expect there will be 1 single cent of Social Security available to you once you reach your retirement years. And who knows what it's going to look like for those still 20 to 30 years away from retirement or trying to get their Social Security. However, one of the very popular ways to maximize this benefit is simply to wait. Delaying your benefits beyond your full retirement age yields an 8% growth per year to age 70. So now delaying benefits can result in higher monthly payments, but of course you'll want to consider your overall financial situation and your life expectancy. I've talked to many people who, although they know they can collect a lot more waiting, they would rather take their Social Security sooner than later before there are any changes to Social Security payments, and because no one knows how many years they will receive this payment and at the expected payment amount. You might consider this move, though, if you have another pool of cash to pull from, maybe a life insurance policy or an investment account, where you can pull from that account instead of pulling from your Social Security or beginning your Social Security in order to let those payments grow by 8% as long as possible. Again, that 8% growth doesn't happen until after you've reached your full retirement age for Social Security payments, which is different based on when you were born. One thing to keep in mind as well is that if you are married, when one of you passes, the survivor will be able to receive basically the higher of the two Social Security payments. But oftentimes people don't really stop to think that when one spouse passes away, they will be losing a full Social Security payment, which can definitely create a hardship if they are very dependent on the two payments. If you have sizable investment accounts in the market, something that could help to preserve those funds in down market years would be simply to, not touch those funds during down market years. That's another great thing about whole life and building cash value. It's that if you have these large retirement investment accounts that you plan to pull from once you retire, and you have built cash value inside of a whole life policy as well, you would be able to access the funds within your whole life policy rather than the retirement investment account in years when the market is down. If you're pulling from your retirement account in a year when the market tanks, it will just further devastate your losses. So having a cash value account that you can access will keep you from having to pull money from your retirement accounts in any down year and will preserve those assets so they will last longer. Well, I hope you found this information helpful for your future planning. If you would like to implement one or more of these ideas and would like to partner with me as your advisor and coach, feel free to reach out to me at Valerie@alphaomegawealth.com. Thank you for listening. I hope you have a great week.
This is thepodcastfactory.com.